vamos a saludar a nuestro siguiente invitado, a Edoardo Cilla, Director Global Macro and Strategic Asset Allocation at Fidelity International. Hi, Eduardo. Good morning.
Thank you so much for having me.
What is your assessment of this macroeconomic environment, higher inflation, higher yields, and central banks nearing the end of their cycle? What is your view of the market?
Exactly. As you say, we believe we are really transitioning a new era. As you exactly said, it started with the COVID pandemic in 2020, and we have now transitioned in a period with much higher inflation that we tended to forget, before 2020. So we are now seeing the inflation definitely higher than central bank targets, especially in the US, in the UK, a little bit more muted in Europe, but overall still quite high across the board, and also higher inflation volatility. So it's not just about the level, but also the uncertainty and the volatility of inflation, and also of GDP and the economic growth. So that all meant, as you exactly said, higher yields, especially on the bond side, on the government side. So we are seeing much higher 10-year yields across the board, especially in developed markets, and also higher correlation between equity and bonds. So this is definitely a new regime that we need to get used to, at least for the next 5 to 10 years. Overall, I think we are cautiously optimistic. There are some good trends there around AI and the potential of AI of pushing both margins for companies, but also revenues, but also some risks. If you think about, the costs and the risks related to AI and the implementation of that, what that could mean for the economies, and also this new trend of global fragmentation, which is really something, that started particularly over the last year, but it's been going on for quite some time, but especially over the last 1 year has been quite strong as a trend, and definitely not something that we would need if you think about the challenges that we have ahead in terms of innovation, this transition, how to leverage AI to make a good impact on the economy and our societies, but also if you think climate change, all these challenges that would need more cooperation, while I think we're seeing more fragmentation at the moment. That's something we need to get used to for the time being.
About AI, do you think valuation are higher, are demanding? It's shaping or will continue to shape the market?
Yeah, exactly. This could be a trend that could continue for quite some time, although we recognize that valuations are quite stretched at the moment, as you said, but you see still some strong fundamentals of companies. So profitability is quite high, leverage is quite low, the amount of cash these companies have is still quite high. So at the end of the day, yes, prices have increased more than earnings, but the balance sheets of companies are still quite strong. In a way, AI really has the potential, as I said before, to change the game, to change our societies, to really help our economies, but also our societies. And there could be some interesting trends, especially on the productivity. So if you think about, making what we do today or what companies do today, but in a much more efficient way, but also pushing revenues. So helping companies get into market segments or customer segments that they didn't have access to before. So that means new business for some companies. Of course, the dispersion is going to be high. There will be winners and losers in this trend. So that's why, especially from an active management perspective, it's important to look through the sentiment and the noise that we're seeing a little bit in the short term, and focus more on fundamentals and try to think about what is the change that some of these companies could bring to, and so potentially invest in some of those names that have higher potential. So there is definitely a lot of opportunities, also some risks. If you think about also the costs related to AI, there is definitely something companies would need to think about around reskilling and upskilling the labor force. So it's definitely not an easy trend to play, but definitely the potential is there. And as you said, again, valuations are quite high. I think the big question is to what extent all these investments that we have seen over the past few years is going to translate into actual earnings, right? So that's a big question. We have already seen some initial, good news on that front. Companies that are starting to leverage AI quite well, especially on the advertising side or customer service side. But I think we need much more in order to say, AI is really going to push the whole economy and help the society to move forward.
Impatience in the markets about regards. Beyond the AI, Edoardo, how to invest in this new environment? Which sectors do you think will be the best performance in 2026?
Yeah, absolutely. So, it can be challenging in a very concentrated market. And as I said before, this AI trend could continue for quite some time because we still see some strong fundamentals of some of those companies. But I think it's now important to think a little bit more about diversification across sectors, diversification across regions and factors, especially on the equity side. There are some good news, particularly in regions like Europe. We are now in an era of new fiscal spending across Europe, but also in some countries like Germany, for example. So that could be a good, a positive news for markets. But also in Asia, for example, in Japan, we have seen structural reforms that really have helped push investor returns. And also reforms we have seen in Korea, for example, or also in other emerging markets like, for example, China or India, that are really playing a strong role in this AI and technological advancements. So there are a lot of positive news, and there are kind of buckets of efficiencies in different regions. So it's really about diversifying a little bit more, and investing today is probably not as easy as buying one single product and market cap exposure, but you need to be a little bit more selective. Think about what efficiency you see in each region, as I mentioned earlier, and play that trend. It's important also to recognize that some asset classes have changed their role. If you think about bonds, now you hear a lot that bonds are back in the sense that expected returns potentially are going to be higher in the future. You see higher yields, which is definitely good news, but bonds as well, have also some risks related to the inflation trends that we were mentioning earlier. The volatility potentially in the future is going to be higher. The correlation with equity is going to be higher. So that's why we're also thinking about how to diversify equity risk, for example, in a multi-asset portfolio. And so the role, for example, of shorter-term bonds or absolute return strategies.
Corporate or sovereign debt?
Yeah, so that's a good point. On the corporate side, we are seeing spreads are quite tight, so they're quite expensive. And while on the government side, I think, our forecast, at least for the 10-year yields, is quite in line with our fair value. So I wouldn't say it's cheap, but neither expensive in that sense. So definitely, corporate can play a role as long as the economic growth continues and there is some resilience on the economic side. That's definitely a good investment. But also, again, as I mentioned earlier, the role of government bonds, I think, is going to be quite important, although different than what we were used to in the pre-pandemic era.
Edoardo Cilla, Director Global Macro and Strategic Asset Allocation at Fidelity International. Thank you for coming to Negocios TV.
Thanks so much.